Next, we have statement of cash flows and the learning outcomes. You need to understand various sections of the statement of cash flows, namely operating section, investing and financing. We have had some discussion on cash flow earlier. Now let us go into further details. In this lecture, we are going to learn how to prepare cash flow statement using the appropriate format for presentation. So before we start discussing the format, let us just see why cash flow statement is so important. The value of the statement of cash flows. First of all, company may be profitable. Company may show profitability, but actual cash on hand is crucial for operational stability, for growth. So it is a key indicator of a company's financial health. So you may be very profitable. What if your banks are all in negative? I mean, they're all overdrawn. So that's why cash is important for the long-term survival of an entity. Profit is good, but does not equal cash. Exactly. That I was just talking about, that maybe your business has generated $100,000 profit, but the total cash available, cash and cash equivalents, are just $3,000. This is surprising. Why? We are very profitable, but we have very little cash. So profitable companies can still face liquidity problems if their cash flows exceed their cash inflows, means their cash outflows exceed their cash inflows. So profit is good, yes, but it is not equal to cash. The reason is that profit is recognized or calculated based upon accrual accounting, means non-cash revenues, non-cash expenses. For this reason, profit $100,000 is not equal to cash available because it is calculated on accrual basis. Next, it says cash flow statement breaks down and analyze the movement in the bank account of an entity. Yes, cash flow statement provides a detailed look into the inflows and outflows of cash. So it will help us understand how the cash position changes over a period, a quarter or a year or a 6 months period. So it is useful for assessing the liquidity of the business, solvency and financial flexibility. What is the difference between these terms? Liquidity means how comfortable a business is in meeting its current obligation. Solvency means how comfortable a business is in meeting its long-term obligation. So liquidity is a measure of ease with which the business can settle its current obligation. Solvency is the business ability to meet its long-term obligation, right? Then it says, the accrual basis of accounting does not apply to statement of cash flows, so only cash received and paid is shown. That makes perfect sense. Because unlike other financial statements that follow accrual accounting principle, like your balance sheet, income statement, cash flow statements solely reflect cash transactions. So this provides clarity on actual cash movements in these three categories: operating, financing and investing. So not just earnings or obligation. The cash flow statement is divided in three main sections, which we discussed previously in our lecture: operating, investing and financing. Definitions. Cash comprises cash on hand and demand deposits. Yes, it includes physical currency, banknotes, as well as funds in your demand deposit account, like your current account called the checking account in the US. So these are the resources available in liquid form, cash in hand and bank, that are available for immediate use without any constraint or any issue. Next, it says cash equivalents. These are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. What does it mean? These are short-term investments that are highly liquid, meaning they can be quickly and easily converted into a known amount of cash. And additionally, they have a very short maturity, typically 3 months or sometimes less, and they carry a very little risk in value, change in value. So for example, treasury bills, issued by the government, commercial paper issued by large organizations, and other marketable securities which have less liquidity risk, which we can sell with minimal risk of change in value. So they are called as cash equivalents. Alright, let us now discuss the various sections of cash flows. First we have cash flow from operating activities. This is the cash used or generated from operating activities. Cash inflows will come from credit sales or cash sales. Credit sales means the collection from customers, cash sales, or any other inflow related to our operating activities. And outflows involve spending on trading and operational activities. I will show you another slide explaining the items that come in. Distribution and selling costs we pay, all these are outflows. Administration expenses, all these represent outflows. So this operating section of your cash flow, there are two alternative approaches to present your cash flow from operating activities. One is direct and other is indirect. Let me show you. This is the cash flow from operating activities using direct method. In direct method, we show all the cash receipts from our operations. Cash received from customers, cash received by selling, trading securities, any interest earned, so not just sales only, any dividend we received on equity-based investments, or any other operating cash inflow. So all the cash inflows less all the operating cash outflows, like cash paid to acquire inventory, less cash paid to purchase trading securities, less cash paid for salaries and wages, interest paid, taxes paid, or other operating cash payments. So effectively, all your operational inflows, consider $10 million, less all the operating cash outflows, let's say $8 million. So that gives us a net figure of $2 million, that is called net cash provided by operating activities, $2 million. So this is called the direct method. This method is preferred by accounting standards. The accounting standard that governs cash flow statement is IS 7, International Accounting Standard 7. So as per this standard, direct method is preferred. So this is what it exactly says. The same stuff. Direct method means the cash inflow from sales and other items I just showed you in the other slide, and outflows related to purchases, outflow related to operating expenses, and outflows related to other operating activities. In the indirect method, we take another approach. We take our profit figure, operating profit, sometimes we take the net profit, and we make some adjustments related to working capital. Any increase or decrease in working capital is adjusted, and adjustments for non-cash transactions. Let me show you what actually it looks like, and it gives us the same answer, whether we use the direct method for cash flow related to operating activities or whether we use indirect. The end result should be the same. The end result should be the same as cash flows from operating activities. This is the indirect method. We start off with our accrual-based income. We make adjustments related to account receivables, inventories, payables. If there is increase, decrease, it is adjusted. So whether you use the direct method or you use the indirect method, the end result would be the same. Whatever the numbers are here, your end result should be $2 million, the same number which you got using the direct method. So this is the figure for our gross inflows. Outflows, the net figure is $2 million using the direct method. Net cash provided by operating activities, you should get the same number using indirect method. Now the question is, which is preferable, direct or indirect? International Accounting Standard Board prefers direct method. FASB, that is Federal Accounting Standard Board, this is the body that is responsible for setting standards of accounting in the US. They also prefer direct method. So IASB and FASB, they both prefer direct method. But practically speaking, I work for many companies and not even a single company I saw direct method being followed. So this is very interesting. Even the accounting bodies, standard setting bodies prefer direct method. Despite this preference, we would see mostly firms, almost 100% firms I work for, they employ indirect method. Why? I will tell you. The standard requires under IASB or FASB, they have similar requirements. If you follow direct method, you need to provide a reconciliation between your operating profit and cash flow from operations. So, despite using direct method, you have to prepare this reconciliation of net income, and means you start off with net income, you make some adjustments and end up with cash flow from operating activities, which means the cash flow from operating activities you calculated under direct method, you need to reconcile your net income with cash flows and need to report this 2 million figure again. And this method, interestingly, is the indirect method. So why don't I just follow this method? I prepare this reconciliation, which is basically the indirect method. So for this reason, you will see that firms in almost all cases follow indirect method. You simply take net income and reconcile it to operating cash flows, which is called reconciliation of net income to cash flow from operations. So this is the method you will see practically. So IASB, FASB, they both prefer direct method, but practically and in academic environment as well, indirect method is used. Indirect method is preferred, and it will be preferred here for this module as well. So how we decide which method to choose, direct or indirect? Both are allowed by International Accounting Standard 7 that governs cash flow statement. Both give the same answer for operating cash flows. I just showed you $2 million. The difference is that indirect method emphasizes management of working capital. It is easier for reporting purpose, but the direct method gives information not available elsewhere in the annual report. Means you receive gross cash inflows and you get the gross cash outflows, and using these you get the net cash flow provided by operating activities. So we are going to discuss cash flow from operating activities, the proper format that is coming in the later slides. Cash flow from investing activities. Clearly, it's a cash flow related to investment in new non-current assets or selling the older assets. So cash inflows come when we sell old, worn out surplus assets, and any interest or dividend we receive, interest income on any non-current deposit, fixed deposit, or any dividend we receive which we have made in any short-term marketable investments. Cash outflows means the payments to acquire new property, outflow, new plant and equipment, outflow, or maybe new intangible assets, or if we make new investments. So these are the outflows. We will discuss the format in the coming slides. The last section is cash flow from financing activities. So this is the cash related to issuing bonds, issuing shares, issuing preferred stock, or any cash we use up to pay the loans from banks, to redeem bonds, or sometimes to acquire our own stock. So cash from sourcing or repaying financing such as owner's equity, borrowing for the long term. So cash inflows involve issuing share capital or taking bank loans or issuing bonds, and outflows involve we pay dividends on shares we have issued, any interest on borrowing. So you can see they are correlated. Borrowing means issuing bonds or loans, and this is the interest on them. Issuing shares involves payment of dividends. This is it. So issuing shares involves you have to pay dividends on those shares, and if you borrow money from bank or by issuing bonds, you need to pay interest, and this interest is paid on borrowing and is shown as a finance expense. So let's say your cash flow from operating activities 2 million plus cash outflow from investing activities net outflow minus 10 million, and cash flow from financing activities, maybe we issued more shares, we issued more bonds, or we taken more long-term bank loan, total 12 million. So this tells us that our net cash increase over the period is $7 million. So this is called as net increase in cash and cash equivalents for the accounting period. To see whether this number is correct, we add the opening cash and cash equivalents balance, 5 million, let's say, if this was the balance of cash and cash equivalents at the start of the period. This is the cash and cash equivalents increase over the period. Your closing figure should exactly be $12 million for cash and cash equivalents. If it is so, then you have done things at least arithmetically accurate. Okay, so here we have the indirect method, operating cash flows. We start off with the profit before taxation. This is the starting point. This is also called reconciliation of your operating profit with the cash flow or cash generated from operations. This is the indirect method, which is required with the direct method. And for this reason, you will see practically businesses use indirect method. So you start off with the profit before taxation. You make certain adjustments for items that do not involve cash. Why? Because profit is prepared on accrual basis, accrual accounting. Accrual accounting means an expense is recorded when it is incurred, not when the cash is paid. Income is recognized when it is earned, not when the cash is received. This is called accrual accounting. And there are many expenses which are non-cash, like for example, depreciation, reduction in the value of the asset is a non-cash expense. This is one of the causes of difference between profit and cash flows. Because when you charge depreciation to find profit, but you don't charge such depreciation in cash flows. So we need to reverse such elements, reverse such adjustments. So we add back depreciation in our profit in order to move towards cash flow. If there is any amortization, amortization is similar to depreciation, but it is for intangible assets like patents, licenses, copyrights. So it's a non-cash expense, it's added. Any loss on disposal, this part only, any loss on disposal of a non-current asset. You sell any asset which is obsolete or which is no longer required, which is surplus, and there is a loss on disposal. So loss on disposal is also a non-cash transaction. So you add back loss on disposal, you add back amortization and depreciation. These items have been used to calculate the profit figure. So now we reverse it back so that we can reconcile our profit with cash flows. So if the gain on disposal, if the loss on disposal is added, if there is any gain on disposal, you sell an asset and there is a gain on such disposal, it is deducted. So remember, depreciation is added, amortization is added, loss on disposal is added, gain is deducted. Then we need to make some adjustments for working capital. This is something you need to understand. So after arriving at the adjusted profit, means in which we have made adjustments for non-cash transactions, now we need to make some adjustments for working capital. Now, let's say our last year balance of inventory was $10,000, or at the start of the current year, January 1st, 2024, and at the end of the year, 31st December 2024, our inventory level is $15,000, right? So if the balance of inventory has increased over the period, clearly by $5,000, think about it. What does it represent? It means inventory balance increase. We have put more money on inventory. So that means it's a reduction in cash. This is how you can memorize. So increase in inventory is deducted. If there is any increase in inventory, it is deducted. Conversely speaking, let's say if your inventory balance at the start was 18,000 and at the end it is 15, which means we sold goods worth or good with the cost 3,000, that would have resulted in inflow. So it needs to be added. The same rule is applicable on trade receivables. If trade receivable balance increased over the period, that means that it's an outflow. If it is a decrease, you add. Prepayments like rent prepayments, like insurance prepayment, same, because inventory is a current asset, trade receivable is a current asset, prepayment is a current asset, so their treatment is similar. So if prepayments balance is increased over the period, it's an outflow effectively, and if it decreases, that means it's an inflow. In the opposite direction, we treat trade payables or accruals. Let me explain. So this figure here is the net of these three numbers. This is the increase, decrease in cash due to changes in the current assets. Looking from the current liability side, let's say my trade payables at the start of the year were 18,000 and it's 15,000 at the end of the year. Think about it. So your trade payables decreased. Why? You have paid. So decrease in trade payable is an outflow. See? And let's say if the trade payable balance has increased over the period, let's say if 18,000 was the starting period amount of trade payable, it increased to $25,000, which means I did not pay. I held on to their payments. I didn't pay. Effectively, it increases my cash flow, so I'm going to add 7,000. So increase in trade payable is added, decrease is deducted. This parenthesis indicates that it's a deduction. Parenthesis here means deduction. Same thing for accruals. If your accrual balance has increased over the period, means you didn't pay. Accrual means expenses which are due. You didn't pay. If the balance of dues have increased over the period, that means you didn't pay. So increase in accrual is added. And if it decreases over the period, like from 28 to 25, it fell by 3,000. So this decrease means you have paid. So decrease is deducted. So net of these figure is here. So now we have our adjusted profit, adjustments in current assets, adjustments in changes in current liabilities, overall changes this one. This, let me show you, this and this, the net figure is reported here, and then this is the figure cash generated from operations. Now we need to make other adjustments, interest paid, taxes paid, and now this is the net cash inflow from operating activities, and this is $2 million, let's say. You can prepare your operating cash flow part using direct methods. In this form, we take receipts from customers, cash paid to suppliers, cash paid to employees. This is the cash generated from operation less same interest paid, taxes paid gives you the net cash inflow from operating activities, which is the same. So whether you use the direct method or you use the indirect method, this figure should be the same. 2 million from direct method, same 2 million from indirect method. Then cash flow from investing activities, and it has no direct or indirect. There is only one method, cash flow from investing activities. You take in all the cash paid to acquire non-current assets, outflow, proceed from sale of non-current assets, inflow, any interest received, inflow. You may report this interest received in operating also. Any dividend received, inflow, and this would be the net cash used in investing activities or net cash flow from investing. It could be either a positive or a negative. So these are all related to investing activities. Then finally we have again, there's only one method for showing your cash flow from financing activities. That is, when you issue shares, inflow. When you receive long-term loans or issue bonds, inflow. You pay dividends, outflow. And this gives you the net figure, net cash used in financing activities or net cash provided by financing activities. So these three cash flows, cash flow from operations, cash flow from investing activities, cash flow from financing activities, give you the increase or decrease in cash and equivalent over the period. Let's say in our example, which said operating cash flows, net cash used in investing, net cash flow from financing gives you the net figure of $7 million. This is what you call the increase in cash and cash equivalents over the period, positive. And to this, if you add the opening balance of your cash and cash equivalents, which is 5 million in our example we are carrying along, it should be equal to the closing cash and cash equivalent. Cash and cash equivalents at the end of the period, $12 million. And if this figure is available in your system, if you add up all the cash equivalents at the end, it means your cash flow statement is at least arithmetically accurate. So your cash flow from operating activities, they differ. There is a direct and indirect method, but your cash flow from investing and cash flow from financing, they are the same whether you follow the direct or indirect method. And yes, we made various adjustments for our working capital. We discussed in detail what is to be added, what is to be deducted, and that's a key part of your cash flow statement preparation. So the adjustment we made related to trade payables, trade receivables, inventories, accruals, prepayments, they are all part of your working capital. So the items which you see here are all called working capital.